This morning on BRN, why now is the strategic time to invest in U.S. office properties. Joining me now to discuss this and a lot more, Patrick Gildea is a managing director with CBRE. Patrick, so great to see you. Thanks for joining us on the program this morning.
Thanks for having me.
Well, we always love talking about real estate on the program, and today we're going to talk about commercial and in particular office real estate. Let's take a step back. Could you just give us a brief synopsis or a brief understanding of where the real estate market generally is today?
Well, it depends on what sector you're talking about because it really differs from product type to product type. But starting in the spring of 22, we saw interest rates begin to skyrocket, and that created volatility across all sectors in commercial real estate. And the sector that's been arguably hit the hardest since that time is office space. We are, now several years into this, called 3 years into this, and beginning to see a real recovery in office, which is one of the sectors that I specialize in. And we're beginning to see a recovery in two forms. The capital markets, so sales and financing, is improving quite a bit year over year. And perhaps even more so, the leasing fundamentals are improving. We've seen that for about 5 quarters in a row so far.
And, during the pandemic, and we all can think about how people were working remotely, it seems to be that that trend has reversed. We see, I think Jamie Dimon at JP Morgan made some statements about bringing the office workers back. I think Goldman Sachs and other big corporations bringing people back in the office. Is that what is really leading to this reprisal, this return to office leasing?
I think it has a lot to do with it, yes. It, of course, does differ from market to market.
Sure.
And you see certain markets that tend to be very professional services or financial services heavy, which have much stronger physical occupancy statistics than some of the others that may be more technology related. But one of the interesting stats that we follow is job growth and occupancy growth by sector. And last year and year to date in 2025, we've seen technology growing considerably. So some markets that are very tech heavy, like a San Francisco, are seeing very strong leasing fundamentals, even on the tech side, which has been probably the most material laggard in terms of physical recovery.
And are the leases, I don't mean to get too technical, and again, I'm a layperson when it comes to real estate, but are they shorter term leases, like what I would lease for an apartment or a condo, or are they longer leases for 5, 6, 7, 10 years?
They're longer leases, particularly what we're seeing now, year to date in 2025. There were a number of circumstances during the pandemic where companies did what we call kick the can down the road. So they would extend for a year or two so that they could delay that decision because they weren't confident enough in their space needs longer term. That's one of the shifts that we've been seeing here in the last 5 quarters is companies are now committing longer term again, and they're more convicted in making those space need decisions for a longer duration.
And are there types of properties that are more attractive than others? Like, you and I both live in the Charlotte area. We have a lot of tall buildings, but there must be shorter story office parks, 1-story offices. Is there a trend in that direction in terms of the types of properties that businesses are looking to lease?
There certainly is, and generally, I would say the theme is that the properties that are in amenity-rich, urban, and mixed-use neighborhoods are performing better. And the Class A properties are generally performing better than the Class B properties. But you can also have circumstances where there are two buildings that are right next door to one another. One is performing extremely well, and the other is not. The difference is generally how well capitalized the ownership is and how proactive they've been in spending capital in the form of amenities, common area upgrades, spec suites, things along those lines. So it's a very bifurcated market, and you're seeing some major winners, but also some losers. One of the interesting statistics that we've tracked over the last 5 years post-pandemic is that 80% of the occupancy loss, this is a national statistic, has occurred in 10% of the inventory in the United States. So there has been trouble, no question, but it's been highly, highly concentrated in 10% of the inventory.
And that's certainly a good sign, especially for the other the other 90%. You mentioned amenities. What types of amenities are we talking about? Is it the sauna, the employee sauna and the pool table? You know that I'm joking. You know, if you've seen the show, what's the tech show that was on Showtime? Any event, you know, during the go-go 2000s and late 90s, it was all about certain amenities. But what are most attractive to office lessees?
Well, you see certain things pretty regularly, which are conference facilities, fitness centers. Now you're seeing things like golf simulators, pickleball courts. Um, to me, it's not as much about what the specific amenity is. It's about having amenities in the first place, which is indicative of having well-capitalized ownership. But I also say to landlords oftentimes, it doesn't matter if it's the golf simulator or the pickleball court or the outdoor balcony, it's having something that's memorable to tenants so that when they get through their survey and they've toured a dozen buildings and they're getting back in their car and going to the airport at the end of the day, there's something that makes them remember your building that's unique and different than what they may have seen in the others.
And is now the time, you know, one of the things that we talk about in the retirement industry, and I'm talking about pensions, 401ks, is the inclusion of real estate as an asset class. And this is very common, for example, in pension plans, as it is in other pools of assets. Is now the time to invest in real estate, given this turnaround that's occurred?
My partners and I think that this is a generational time to invest in real estate and in office specifically. Again, the fundamentals are clearly improving. We have 5 quarters in a row of positive absorption. In many of the markets in the United States, we're seeing tenants and market activity that rivals pre-COVID levels, and in some cases exceeds pre-COVID levels. So we feel very good about the state of the market. We're also entering a period of time where we're going to see very little to no new construction in most markets. And you could argue in many markets that we're going to run out of the top quality space. So as a result, we'll start to see rental rate growth in those better quality properties in better locations. And if you look at the basis and the return on a lot of the office trades in any market in the US right now, there are historically high returns from a cap rate perspective and historically low basis, particularly as compared to replacement costs. So I firmly believe that this is a generational buying opportunity.
And would this be something for you know, direct purchase or, for example, real estate investment trust? I think those vehicles are kind of common to our audience.
Well, historically speaking, over half of the buyer pool in our sector was institutional in nature. So whether it was a pension fund, private equity fund, REIT, life insurance company, whatever it may be, the majority of capital was institutional, oftentimes made up of individual investors, as you said. Right now, we're seeing more private capital than institutional capital if you look back the last couple of years. But I will also say we're starting to see that shift back closer to historic norms. So we are starting to see more traditional institutional investors re-enter the space.
And last question, I mean, are investors, based on your interactions, breathing a sigh of relief? I mean, I can't tell you how many times I turn on the news and or read an article that said, you know, office space was not doing well, and they were thinking about converting it to either retail or homes, which I think would be challenging. But are people breathing a sigh of relief?
Many are. There are still certainly owners that are in a challenging situation, and whether it's due to a loan that's expired or their basis just simply being too high to make sense of that specific investment today. You know, there are owners that have gone through pain in the last couple of years and will continue to go through pain, which is unfortunate. But at the same time, I think the majority of investors who are investing today that don't necessarily have some of those historic issues in their own portfolios are very optimistic about what they're seeing. Again, recognizing that there are still some folks who still have the challenges in front of them, that make it a little bit more difficult to see that opportunity or make it harder for their investors to support investing today until they've been able to fix some of their legacy issues.
Well, I guess we're trending in the right direction. I guess only, as they say, only time will tell. Patrick, thanks so much for joining us. Great to see you. And look, we look forward to having you back on the program again very soon.
Absolutely. Thank you, Jeff. I appreciate the time.
And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place. Details, of course, at our website. And your subscription supports all this great BRN content. We're back again tomorrow for another edition of BRN. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.